Hello, everyone, and welcome to my YouTube channel. As always, it is a good opportunity to have an interesting discussion with people that know what is going on. And today I have the distinct pleasure of having Keith Weiner. He's the CEO of Monetary Metals. How are you, Keith?
I'm doing well, and thanks for having me.
It's a great pleasure. Keith, I would like to start talking a little bit about where do you see the situation right now in terms of inflation globally, and what does that mean for currencies and precious metals?
So, interesting question. I think most people are very focused on the quantity of what they call money, and the Fed and the other central banks have certainly been prolific in creating more currency units. But what the Fed does, and the other central banks in slightly different mechanisms, is they go to a bank and they replace the bank's holding of a treasury bond with cash. It's not like the bank is going to suddenly then bonus out that cash to their employees to go spend it on consumer goods. And so people say, well, the extra money that's being created is sequestered in bank reserves or whatever, not going out. But I think we should take a broader view of all this. And so I have two ideas to kind of introduce to the conversation. One is that there are very significant, at times there can be very significant non-monetary forces driving prices up.
Sure.
They can also drive prices down. And so when we have improved industrial efficiency that drives prices down, it's not a monetary phenomenon. And right now we have two huge non-monetary forces driving prices up. One is trade war. And the origins of that go back to the protectionist fallacies of the mercantilists, hundreds of years ago. But I think it really got its current start under the Trump administration, and this idea that, each country should, manufacture its own and buy its own, pull its supply chains in. And when you look at the global supply chain for something like semiconductors, it is truly global. You have things going on all over the place. You're buying, if you're Intel, for example, you're buying some things from one place, you're buying, machines from another place, you manufacture something in a third place, and then you're sending it to a fourth place for assembly and test. And then all of a sudden, for politicians to say, pull all that in locally, and other governments suddenly saying, wait, we don't trust these Americans anymore, we have to pull back. You've created quite a lot of dislocation, quite a lot of upward pressure on prices, and not just in semiconductors, but for example, in automobiles, where they can't get the chips they need to make the cars, all kinds of stoppages and things like that. Again, all non-monetary. Number two, we had this terrible disease, COVID, hit in 2020, and the response was to lock everybody down. And that was a global, it was fantastical to watch that suddenly every government in the world agreed with this idea of locking people down. And then all kinds of weird things happened in the United States. There was a time when about a third of all the meatpacking plant capacity was shut down. So consumers see great inflation, so-called, in the price of meat, and yet the people that are producing, the ranchers and farmers that are producing beef and pork, are seeing a zero bid on their product, and they were slaughtering herds wholesale because they couldn't afford to feed them anymore and they weren't being able to sell them. And so these kinds of dislocations are non-monetary, and I think that is largely what's going on. The other idea that I introduced to the conversation is that a falling interest rate tends to put downward pressure on prices because the cost of borrow is the marginal cost for any producer looking to expand.
Sure.
If you own a hamburger restaurant chain and you're always playing with your spreadsheets thinking we could open another store. And then there's always something that stops you from doing so. And then they lower the rate of interest and suddenly, ding, your spreadsheet turns green. It makes sense. And so there's always a stimulation or stimulus to create more capacity every time they lower the interest rate. And so that is a downward force on prices that we've had since, the interest rate's been falling since 1981.
Yeah. No, I completely agree with you. I think that the lower one of the mistakes that many people make about monetary policy is that they believe that it's going to generate huge inflation by lowering interest rates and increasing money supply. But when a lot of that money is going to perpetuate imbalances like overcapacity, and there's plenty of it, definitely that is a
Yeah, that's right.
disinflationary process, not quantitative easing also by leading most of the money supply to the to sovereign bonds and financial assets also generates disinflation because a lot of the beneficiaries of newly created money are also disinflationary industries like technology. That is absolutely correct. However, I would like to introduce something to you and see what are your thoughts there, because we have seen, for example, that within that reality that you've just mentioned, numerous commodities in which there is plenty of capacity, in fact, there is massive overcapacity, have gone up almost as much, if not higher, than the average of the commodity basket. And that the difference in 2021 comes in the monetary aspect of inflation from the fact that in 2020 was the first year in which the European Central Bank and the Fed, the generators of reserve currency, basically generated increased money supply significantly above the demand that existed for that money, as compared to other years in which that demand was more or less balanced with the level of supply, and that is generating part of the inflationary pressures that we're seeing in, for example, public services that have little to do with capacity constraints or supply chain disruptions. No?
I think it's still largely the dislocation. So one of the commodities that is very interesting to look at is lumber or timber in the US. And so when you had lockdown hit, it created a great dislocation of people moving out of certain cities.
Yeah.
Especially the cities that had the most restrictive lockdowns became very unpleasant places to be. Yeah. New York City, San Francisco, Chicago. And I know people who've moved out of all three of those cities, lifetime residents who said they would never move, who didn't move when things were really bad in the 1970s, and finally just moved out, and then they bought houses. Plus, a lot of people did remodeling. Suddenly they were at home. They had to make a home office or whatever. So there was a lot of home remodeling projects. So the price of lumber skyrocketed. Yeah. And I think this is one of those commodities that went up far faster while it was going up than anything else. And a lot of people said inflation, to which I would say, well, I think this is COVID-related dislocation. And now, of course, the price of lumber has come back down, sort of establishing that it might not have been a monetary, if it was monetary, the price should stay up. There should be no reversing of the monetary effect.
It could, wouldn't it? But inevitably, one of the reasons why it went up threefold, 4 times more than probably the fundamentals that you just mentioned happened was precisely because there was a large quantity of money looking for scarce assets. It does not necessarily need to stay up. It just generates a level of inflation. For example, if something goes up, I don't know, 100% and comes down 50, you still have 50% inflation.
Well, yeah, obviously, if it stays elevated, then I would agree with that.
Yeah, but I think that is the problem that the concern I have once, because this is the second month already in which we have had an inflation print that is after the base effect, and the reopening of most industries. You can understand that it catches you for a quarter. It doesn't catch you for already a year now in most global economies. But one of the concerns that I do have is that the narrative of transitory inflation that the Fed is working with, and the ECB as well, comes from obviously quarter on quarter, year on year inflation, no? But that what we saw in 2020 that prices didn't come down despite the lockdown and the collapse of the economy, and in 2021 they're going up. So in terms of accumulative inflation, the reduction in the purchasing power of salaries for citizens is quite significant despite that transitory rhetoric. And even if it was, we see that, for example, copper, oil, sugar, coffee, yes, they come down, but they come down to a resistance or a support level, if you want to call it, that is significantly higher, 20, 30% higher than what it was pre-lockdown. No? What is your thought there?
Well, obviously, if you're earning a salary and then the cost of everything goes up, you're squeezed. I mean, that's the bottom line. And there's nothing else need to be said about that. That's a period, not a comma with a but. Period. That's terrible. As an economist, and particularly one who focuses on the monetary side, I'm interested in, okay, is the root cause of this monetary, or is the root cause of this what I call lockdown whiplash? So one of the bizarre things that's happened in the U.S., and I think something similar in the UK, and I don't know about in the EU, is massive programs were created to pay people first because they were not able to find work.
Yeah.
But now that things are resuming to some degree, these programs continue to pay people and offer them an incentive not to work.
Yeah, furlough jobs.
So,
yeah.
In a certain sense, you could say it's monetary. The Fed is enabling the government to borrow trillions and trillions of dollars and equivalent in other countries around the world in order to pay these people this welfare. But there's a very perverse incentive not to get a job. And so, here in Arizona, I observe this kind of weird thing where there's all the people who would have been working in the restaurants are now actually going to the restaurants and trying to enjoy. And so the restaurants are understaffed. And Arizona is a seasonal economy for hospitality because it gets very hot here in the summer. Even in early September here, temperature is still well above 100 degrees Fahrenheit.
Yeah.
More like 108. So what is that in centigrade? Low to mid 40s.
Yeah.
So very hot, not a pleasant place to be. And so normally we don't get a lot of holiday people here in the summer. And then a lot of the natives try to get out when they can. And so the restaurants are generally empty in the summer, but not this summer. They've been overcrowded.
Sure.
And particularly with the staffing limitations the restaurants have had. So all of these things, you could look at so many different markets and see how supply chain disruptions, perverse incentives, the rental market, the government declared a moratorium on evicting people who don't pay rent.
Yeah.
And so now you have, I don't know how many millions of rental units not, earning anything for the landlord, which is one set of problems, but all those people are occupying a unit that would otherwise be on the market. And so the remaining units that are on the market, the rent goes up.
Yeah.
Not a monetary phenomenon. So I think they're huge dislocations that I think will take much longer than a quarter and probably a number of years to resolve. But so for instance, take one that I thought about a little bit, which is the dislocations in shipping.
Yeah.
One of the big problems is there's such a shortage of shipping containers right now that in some cases, if you're a US manufacturer producing something to export to China, your goods can't get in an empty container because there's such a rush as soon as the container is empty, there's such a rush to put it on a boat and send it back to China. They're not even waiting for your cargo.
Yeah.
And so there's that dislocation. I can only imagine there must be right now in China, X number of companies that are manufacturing more shipping containers at whatever rate that they can run their machines 24 hours a day, 7 days a week. Eventually that's going to catch up. And then what we're going to find is the shipping market is going to be awash in surplus capacity and prices will crash. but the lags involved in that could be a couple of years.
Oh, I completely, I think that that is a very, very good example that of that, whiplash effect that you mentioned, the bullwhip effect of the reopening, generating a certain incentive to create higher overcapacity. It happened with the ports, and it happened in shipping as well. Remember that until very, very recently, the shipping market was in massive overcapacity. The Baltic Dry Index, the Panamax, all of those indices were showing very, very low rates to higher shipping. No, I think that I ultimately my view at least is that that is in itself, just like the furlough job impact on tightening of the services sector, is a monetary phenomenon. The government is extracting capacity out of the system, generating false sense of tightness in the labor market, because there's, in the case of the UK, it's about 2.2% of the labor force still that remains in furlough jobs. So you're absolutely right. It's we can categorize it as a supply chain disruption but ultimately that doesn't happen if there is no government that is increasing dramatically the deficit that is financed by money supply to finance that spending. So I think that the point that you're going to, which is that the impact that we're seeing right now is going to last longer than many expected, which we completely agree, and that probably may generate overcapacity in the future. What do you think? Don't you think that the response this time from economic agents is being quite more subdued? Is that instead of reacting to an abrupt tightness in capacity or an abrupt increase in prices, what many of companies have done is actually not to invest in further capacity. For example, we're seeing it, South Korea is not building more ships than what they were building 2 years ago. So maybe this time the response that leads to the disinflationary pressures of overcapacity is more subdued, or at least takes longer to come to fruition. What is your thought there?
Do you have the there was a cartoon in the United States for many years called Peanuts with
Charlie
Brown. Was that a popular thing in Europe?
Absolutely, Peanuts, very popular, Charlie.
It was a classic thing that recurred several times, where was it Lucy holds the football for Charlie, and Charlie goes back and he runs to go kick it, and every time at the last possible second she pulls the ball out of the way and he tries to kick it and he falls on his back.
Yeah.
And after several times of that, I don't think he ever did in the cartoon, but he should have learned to distrust hey, I'll hold the football for you. I think there's been a number of episodes of temporary tightness over recent decades, and I would have to assume that corporate management is feeling a little bit once burned, twice shy, or there's too many cries of wolf, and so not responding. And I remember looking at after the COVID lockdown first hit, there was a tremendous shortage of toilet paper, of all things. And looking at that, now this is probably as good an example as any. It's capital intensive to manufacture this. I don't know what the machines cost, but I imagine those are very big, very expensive machines. And it's a low margin product too, although I guess the margins went up at that point. If you thought that, because they initially said 2 weeks of lockdown to flatten the curve, nobody's going to make $1 billion investment for 2 week shortage. How long does it take before it begins to become clear that the new market reality is durable? It's not 2 weeks. And we see the same thing, and I've written a lot about this in precious metals, in the capacity to manufacture the coins. People say there was a silver shortage And I say there was a shortage of 1-ounce coins and small retail products, not the 1,000 ounce bars, because the equipment, so stamping the coin is easy and cheap. All you need is a press.
Yeah.
Manufacturing the blank, because it has to be a very precise weight. Think about it. Every manufacturing process has variance.
Yeah.
But if you have less than 1 ounce of metal in that coin, it's called fraud.
Yeah.
So all of your variance has to be above the 1 ounce. And of course, you don't want to give away too much metal because you're giving away. So anyways, there's a lot of precision in that, and it has to be polished to a certain spec. And the amount of equipment that exists to do that is finite. And then when demand suddenly, explodes, the production capacity is inelastic.
Yeah.
And they can't meet demand. And there's a good example of an industry that has had the football pulled out. There's a big spike in demand. Somebody borrows more money to expand capacity. We've spoken to a few companies like that. That's our business. We lease metal. For years, post, let's call it 2014, 2015, they were just awash in excess capacity. And, the price that they could make, the margin they could make, manufacturing a coin blank was like pennies in silver. It was nothing. And, so then you have this big explosion in demand, same thing in toilet paper, same thing in so many other products that people use at home that they either didn't use in the office or use differently. And now suddenly there's a demand for the home version. Well, how long does it take before those companies decide that they want to borrow huge amounts of money to build that capacity?
Yeah.
But here's the thing. And you say the Koreans are not increasing their production of ships.
At least yet.
Yeah, I was going to say yet. But here's the thing. With the interest rate low and falling, ship manufacturing is obviously a global business, and you have it in a number of places, around the world. It only takes one to decide to borrow.
Absolutely.
And then any competitor who didn't is now at a relative disadvantage.
Yeah.
And so every time the interest rate ticks down, that is an increase in the incentive. The incentive keeps changing and it keeps becoming more enticing to somebody to borrow.
Yeah.
The other thing I would say about the interest rate is, if the interest rate is not rising, then that puts the lie to that the economy is booming. It says essentially that corporations are not bidding up the interest rate, that the demand for credit is very soft, and this has been the case certainly at least since 2008. The demand for credit is very soft, except on the downtick in rates. So if you think of bid and offer on interest rate, which is I kind of how I think of it, and all the corporations have a bid on the interest rate, but they won't take the offer. They wait for the bid to come down, or they wait for the market to come down and hit their bid. And then, you get credit creation, again, for corporate production purposes on a downtick in the interest rate, but they don't chase it up. The 1970s, 1960s, they were aggressively chasing it up because new credit creation was going into inventories, going into commodities in that period. And today, financial assets.
Yeah, absolutely. And obviously right now, there's also a different environment in which, again, from my perspective, that is, again, a monetary phenomenon, is that it's not that companies are not investing what they require, is that they're not investing as much as central banks would want them to, or governments would want them to. Because A, they see overcapacity, B, they don't see that incentive that you just mentioned yet. And therefore they can afford to delay 2, 3, 4 projects for a couple of years in order to maintain the borrowing cost, not just low, but diminishing. No? So I think that is an important factor that you just mentioned, because I think that the one defining difference versus other periods of aggressive stagflation that is one of the words that keeps coming up, is obviously that interest rates, in my opinion, and I wonder what's your view, will continue to be extremely low, and that the level of financial repression will continue to be at extreme highs.
Yeah, absolutely. I mean, the first thing I say when people say the interest rate is going to start rising now, as I say, it's been falling for 40 years. That's the fact. Before one can predict it to rise, one should form a theory as to why it was falling for 40 years. And if your theory is, well, the governments are spending deficits and the central banks are printing money, that's been happening for 40 years.
Yeah,
So what changed now? And my argument is nothing changed.
you bet.
We're in the same environment that we were in last year or the year before. COVID has changed some things, obviously, but monetarily, we're in the same environment, which is, so another example I have for soft credit is, at least in the United States, and I don't know if this is true in the rest of the world, the car makers offer 0% financing for very long periods of time. A little bit less now, I think, but there's still plenty of car companies offering 0% for 72
Absolutely.
months.
Absolutely, they do. I just purchased a new vehicle and I got 0% credit.
So, 0% for 72 months, 6 years is typical in the US, and occasionally I see ads for 84 months, which is completely crazy. But leaving aside my value judgment of that, and this has been going on since even before 2008. So in 2000, was the end of 2014 is when they started to talk about raising interest rates.
Yeah.
And Janet Yellen was going to be the new Fed chair, and there was this brief attempt to raise the Fed funds rate a little bit. And so the cost of borrowing, I mean, if you're Ford Motor Company or General Motors, the cost of borrowing went up, pretty considerably. But they continued to keep that subsidy at 0% to the consumer. Now, why would they do that? Is obviously they have smart marketing people who are capable of doing the math. And they're taking a loss on every car that they finance at zero when their own cost suddenly went from, which was never zero in the US, their own cost was probably, even in a zero rate environment, let's say their cost was 2%. So there's a subsidy to give you zero, but then their cost went from 2% to say 4%.
Yeah.
So their cost, let's say doubled. And I did some math. I wrote an article back at the time that was probably taking off at least $1 billion a year on Ford Motor Company's profits. It was huge. Yeah. The marketing people must have calculated that if they increase the cost of lending to the consumer to match their increased cost of borrowing, then the drop in car demand would have been so great that the losses would be even bigger.
Absolutely. Absolutely.
And so what that's saying is essentially that, again, the demand for credit, and I guess a car is sort of a combination of consumer good and capital asset. It's a capital asset because it lets you drive to work and earn a living. It's a consumer good. But the demand for that, no matter how you slice it, is soft, except when the interest rate is zero, and ultimately will take a downtick. Like you get saturation even at zero, and the corpus economic becomes, what's the word when somebody builds a tolerance to a drug. So they take cocaine, and at first they get a big high, but then after a while, the same dose doesn't do enough anymore, and they have to increase the dosage.
Yeah, absolutely. Yes, exactly. That is the key. That is absolutely the key, is that the working capital requirements of companies become so great when the slowdown in sale happens that the math that you just made becomes intolerable. And we saw that, and it's been very evident with airlines and with automobile manufacturers in the Eurozone. In the Eurozone, in which, because at least in the United States, there is a culture of changing vehicle quite more rapidly than we see in the Eurozone. But if you look at the challenges in terms of vehicle sales for manufacturers in the Eurozone, has been huge. With very small decrease in changes in the inventory. So that's so they say, okay, we have our warehouses full of unsold vehicles, and we're going to try to offset our borrowing costs by increasing the lending rate. That's not going to happen. It is not going to happen. And obviously then that leads probably to the second part of our discussion about inflation, which is I seem to get the idea that what you see is that post-inflation and the bullwhip effect, you see that disinflationary pressures creep in back, no?
Yeah, and I think when they hit, it will be with a vengeance.
With a vengeance.
It could be a couple of years. It's not going to occur tomorrow. But yes, absolutely coming back with a vengeance.
Yeah, we had a discussion.
One analogy I'd like to use for all of this is the monetary authorities, the Fed, the ECB, the Bank of England, Bank of Japan has been trying to do this for decades, right?
Yeah.
They think if you increase quantity, then consumer prices sooner or later have to go up.
Yeah.
And analogy I like to use is if you're a pilot flying an airplane, every layman knows if you pull back on the yoke, that will cause the plane to climb, or supposed to cause it to climb. And so many small, amateur pilots flying small airplanes crash because they don't really understand the instruments.
Yeah.
And if they get into fog, or if they're flying at night when they shouldn't be, if the plane is flying level and going down, you pull back on the yoke. That's the right answer.
Yeah.
If the plane is in a descending spiral and the amateur pilot and he sees the altimeter is falling, he doesn't recognize that the plane is tilted, which he doesn't picture in his mind. That means a spiral.
Gotcha.
If you pull back, I've been told, and I'm not a pilot, but I've been told by pilots, if you're in a spiral of a certain degree of tightness and you pull back on the yoke, what it does is it tightens the spiral into an auger that goes straight down faster and faster.
Yeah.
And
the Japanese, absolutely. Japanization of the economy without the discipline of the Japanese workers. I always remind people of this, that what we face is not the same as Japan, because you don't have that level of discipline in corporates and in the workforce. We have a few minutes left yet. I would like to get your thoughts on where that leads to the evolution of gold prices in precious metals in general, and the demand for those reserves of value.
So I think that 2008 was a major inflection point, in the sense that you had huge numbers. So, I fly around the world and talk to a lot of people about gold, and not just in the US, but in Europe and also Asia, Australia. And, I'll just pick on my fellow Americans as probably the least understanding of gold of any place in the world. because we've been fortunate, we have not had any real currency crisis in 200 and something years. We've had a few episodes, but nothing like what most of the rest of the world has had. So Americans are very trusting of our currency, for that reason. But in 2008, millions of Americans suddenly realized that our monetary masters are not either competent or honest, and bought gold for the first time. And while I'm sure some of them sold the gold after 2012 when the price was falling, most of them would have kept a certain amount of it just as an insurance against, what could come.
Yeah.
And so there was obviously a step up in demand, as those people took a certain amount of gold permanently out of the market, and now it's sitting in their home safes or sock drawers or bank deposit boxes, whatever. I think the same thing happened post-COVID. I mean, we saw it with our client base, a huge step up in demand, and in many of our lessees, with these gold to bullion dealers, a huge step up in demand that hasn't really stopped.
Yeah.
Post, in terms of volumes anyway, post, April 2020. And I think it's the same thing again. If the economy seems to be normal, everybody has a job, everybody can go for drinks and food after work with their friends, and everybody seems to have a little bit of pocket money, most people aren't really thinking too much about the deeper systemic, problems.
Yeah.
When there's something, a crisis that rises above the waterline, and suddenly it's visible, And, in the United States, obviously we had lockdown, that's not good. But then, we had this so-called CARES Act. And they care because they called it CARE. And they spent, first it was 2.3 trillion, they added another $0.5 trillion to it. It was like $2.8 trillion on top of the deficit that was already over $1 trillion. And then meanwhile, tax revenues obviously falling because businesses aren't making money anymore. So, now you're suddenly going from $1 trillion deficit to maybe a $4 or $5 trillion deficit or more. And a lot of people can see that and say, my God, I mean, we economists can sit around and debate the nuances of, quantitative easing and bank reserves and all these things. But the average person, they're like, this can't be good.
Yeah.
Something is going to happen. I don't know what, I don't know when, but it's not going to be good.
Yeah.
And so it's logical that I want to own some gold to, somehow protect myself or feel a little better, be able to sleep at night, really.
Absolutely.
And so I think there was a whole nother group of people that came to gold for the first time in 2020 and now in 2021 that hadn't come to gold before, not even in 2008, 2009.
Yeah.
And of course, all the 2008, 2009 people are still in gold. And so it's really giving the market quite an education in the problems with trusting the currency and the monetary authority.
That makes total sense.
And they can also see the unsoundness of it, that the government calls this borrowing, and yet it's obvious they have no way to repay it and no intention to repay it.
Yeah.
So what's going to happen to the creditors? And so if you have a treasury bond, obviously you're a creditor, but if you have a dollar bill, you're a creditor as well. And maybe more and more people can sort of sense that at some level. And so I think they turn to gold. And then we have the Bitcoin phenomenon. And I'm not necessarily a proponent of Bitcoin, but one thing that Bitcoin has done is it has brought to tens of millions of people, what used to be called the currency debate.
Yeah.
100 and something years ago. And, this idea of, well, what is money and what is sound money and all these things. And now tens of millions of people are talking about it and debating it and tweeting about it and all these things, and all of which, lead a lot of people to gold, as well. And so I think there's a sea change just in attitudes. If that many Americans are now, looking away from the dollar for the first time, that's a new thing.
Yeah.
It was not a thing before 2008.
That's a great point. That is a tremendous point, and I completely agree. And you need to have, I always say, you always need to have gold keepers in a portfolio, guys. And gold is a goalkeeper in a portfolio full of correlated assets. Keith, has been an absolute pleasure to talk with you. I've had a great time. I hope that you have some time in the future to continue with conversations like this. And thank you so much. Thank you so much for joining us. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.